Welcome back to the deep dive. Today we're really getting into the psychology of trading. Not the charts, not the indicators. We're talking about your mind, the single biggest factor in whether you succeed or fail in the markets. Look, we know you've probably got a strategy, maybe you've back-tested it, maybe it even works sometimes. But if you're like so many traders, you hit that same wall again and again. Inconsistency.
Right.
One good week, then bam, two bad ones. You know the drill.
Absolutely. And it's usually not the strategy's fault. It's panic, it's fear, it's greed. You do the classic things. You cut your winner short because you're terrified the profit will just poof, disappear.
Or worse, you let a small loss just grow and grow, hoping, praying the market will turn around and save you.
Yeah,
paralyzed.
That hope is killer.
So you've got this constant battle, right? The logic of your plan versus this emotional storm inside. Fear, greed. It just takes over. Okay, let's unpack this. We're digging into Mark Douglas's classic book, Trading in the Zone, for this deep dive. Our mission here, to find that psychological blueprint, the mental framework you need for consistent, repeatable success.
Yeah, and the first big takeaway, the thing Douglas hammers home, is that the problem isn't the market. It's never the market. It's not even really the strategy. It's your mindset. Full stop. Good plans fail because you deviate, because those internal emotions, fear especially, make you abandon the plan right when you need it most. So the goal isn't just tweaking your entry rules. It's like rewiring your brain to think about the market like a professional does, objectively.
And Douglas really pinpoints why we feel that pain, that fear. He says it comes from fighting reality, basically.
Yeah.
Fighting what the market is. We go into a trade with these heavy expectations, with this deep need to be right about what's going to happen. Ego gets involved? Exactly. And when the market does something unexpected, something random, which it does all the time, it feels personal. It moves against you. And suddenly you're feeling anger, fear, frustration. It feels like the market took something from you.
Right. That personalization is the trap. You start thinking the market's out to get you. But Douglas is clear. The market is just information. It's a constant flow of opportunities. It's neutral. It doesn't know you exist. It doesn't care about your position. We're the ones projecting feelings onto it. A loss feels like failure, feels like judgment. That's what leads to revenge trading, moving stops, all the destructive stuff.
Okay, so if fighting the market's randomness is the problem, what's the solution?
It's a concept Douglas calls radical acceptance.
Radical acceptance, okay.
You have to truly, deeply accept that the market can do anything at any time. There are no guarantees, none.
That sounds tough to actually internalize.
It is. But here's the paradox. Douglas argues you don't need to know what's going to happen next to make consistent money.
Wait, say that again? You don't need to know what happens next.
Nope. You just need an edge, and we should probably define that quickly.
Yeah, good idea. What's an edge in this context?
An edge is just a strategy, a set of conditions that over a large number of trades has a statistically higher probability of making money than losing it. It's a positive expectancy. Crucially, it tells you nothing about the next trade, only about the average outcome over, say, hundreds of trades.
So accepting you don't know what's next, even with an edge.
Yeah.
That's the key.
That's the core of radical acceptance. What's fascinating here is realizing that all the mental energy spent fighting randomness, trying to predict the unpredictable, that's the main psychological barrier. The best traders aren't crystal ball gazers. They're masters of acceptance. They've surrendered to the uncertainty, and that surrender, ironically, gives them control over their own actions.
Okay, so if I accept uncertainty, how does that change how I think about trading?
It forces a massive shift. You move from thinking uncertainties like, this trade has to work, to thinking purely in probabilities.
Probabilities.
Yeah.
Like statistics.
Exactly. Think about it. Even a great edge, maybe one that wins 60% of the time, that 60% only shows up over a big sample size. 100 trades, maybe more.
Right.
Any single trade. It's basically random. It could be one of the 40% losers or one of the 60% winners. You just don't know which one this particular trade will be.
So the focus shifts.
Completely. Your job isn't predicting the outcome of this one trade. Your job is to execute your edge flawlessly again and again and again so the probabilities can actually play out in your favor.
And this is where Douglas brings in the casino analogy, right?
Yes. Here's where it gets really interesting. Think about a casino, a huge successful one. They know they're going to lose on individual hands of blackjack, individual spins of the roulette wheel. Happens constantly.
Yeah, they lose millions in payouts every night.
But do they get emotional? Does the pit boss start sweating when someone hits a jackpot? No.
They don't care about the single spin.
Exactly. They don't chase losses on one table. They know their underlying mathematical edge.
No.
The house advantage guarantees profit over thousands, millions of bets. Their whole business is built on executing that edge perfectly over a massive sample size and ignoring the short-term noise. That detachment is what we need as traders.
Okay, but hold on. A casino is dealing with machines, probabilities baked into the games. They have huge amounts of capital. How can a regular person, maybe trading with money they really need, achieve that same level of detachment? It feels different.
That's a really important point, and it's challenging. The key is how you define a loss mentally. For the casino, a payout isn't a failure. It's a business expense. It's the cost of running the game, the cost required for their long-term edge to work.
A cost of doing business.
Precisely. So if you, the trader, can genuinely adopt that same frame, a losing trade stops being a personal blow. It's not failure. It's just the statistical cost of playing the game long enough for your edge, your 60% win rate or whatever it is, to actually materialize.
So a loss becomes like a subscription fee, the price of admission to let your edge play out.
That's a great way to put it. And once you truly internalize that casino mindset, the emotional sting of a single loss just dissolves, mostly. You're no longer desperate for this trade to be right. You're just focused on executing trade number 5 according to your rules, knowing its real significance is part of the pattern you'll see after trade number 100.
Okay, so accept randomness, think like a casino. That's the mindset shift. How do we make that concrete? How do we, install that thinking?
Douglas provides a structure for that. He calls them the 5 fundamental truths of trading.
The 5 fundamental truths, okay, like core beliefs.
Exactly. These aren't just nice ideas. They need to become your deeply held beliefs about the market, replacing the old faulty ones based on prediction and expectation. If you really get these, you stop trying to predict and you just start executing based on your edge.
All right, let's hear them. What's the first one?
Number 1, anything can happen. Just pure, raw uncertainty. Accept it. Whatever you think can't happen in the market, it can. You have to acknowledge the possibility of the worst case on every single trade before you take it.
Okay. Brutal, but clear. Anything can happen. What's 2?
Number 2, you don't need to know what is going to happen next in order to make money. This one is incredibly liberating, I think.
Yeah, that takes the pressure off predicting.
Totally. You don't need a crystal ball. You just need your edge and the discipline to follow it over and over. That's it.
All right. 1 and 2 are about accepting uncertainty and letting go of prediction. What about 3?
Number 3 connects to the probabilities. There is a random distribution between wins and losses for any given set of variables that define an edge.
Random distribution, meaning?
Meaning even with a winning system, your wins and losses can come in streaks, clusters, totally random patterns in the short term. You might hit 10 losses in a row, even with a 60% win rate system.
Wow, 10 losses. It would shake most people's confidence.
For sure. But if you know the distribution is random, those 10 losses don't mean your edge is broken. They're just a statistically normal clump of losses that you have to trade through for the long-term average to prove itself.
Okay, that makes sense. It manages expectations about consistency in the short term. What's 4?
Number 4 defines the edge itself. An edge is nothing more than an indication of a higher probability of one thing happening over another.
Just higher probability, not a guarantee.
Exactly. It's not certainty. It's just a slight tilt in your favor. Maybe it's 5-5-45. That edge only pays off if you apply it consistently over a huge number of trades. You're betting on a small statistical advantage repeated many, many times.
Right. It emphasizes the need for volume for sticking with it. And the last one, number 5.
Number 5, every moment in the market is unique.
Unique. Even if a chart pattern looks identical to one from last week.
Yes, because the underlying conditions, the participants, the news, the global context, infinite variables are always slightly different. Relying too heavily on, this setup worked perfectly last time, so it must work now, is a trap.
So it prevents rigid thinking. You have to stay objective and flexible because the context is always changing.
Precisely. You need to see what the market is doing now based on your edge, not what you think it should do based on the past.
Okay, those 5 truths.
Yeah.
Anything can happen. Don't need to predict. Random distribution. Edge is just probability. Every moment is unique. That's a powerful framework.
It really is. And Douglas says when a trader truly integrates these beliefs, when they become automatic, that's when they can enter the zone.
A zone. Sounds a bit mystical.
He doesn't mean it that way, really. It's not about levitation. It's a practical, operational state of mind. He calls it carefree confidence.
Carefree confidence. I like that.
It means you're focused, you're executing your plan, but without all that internal noise. The fear, the second-guessing, the emotional roller coaster that kills consistency.
So what does that look like in practice? How does a trader behave differently when they're in the zone?
The changes are very concrete. First, because you've accepted uncertainty and defined your risk before entering, you lose the fear of loss. That means you don't hesitate. When your setup appears, you take it. No feesing up, no missing opportunities because you're scared.
Okay, no hesitation on entry. What else?
Second, losses are handled differently. Because you see them as that cost of doing business, if a trade moves against your predefined stop-loss point, you just cut it instantly. No questions, no hoping it comes back.
A hope factor is gone.
Completely gone. And the flip side is also crucial. You let your winners run. There's no anxious urge to grab a small profit immediately because you're afraid it will disappear. You trust your edge to capture bigger moves when they happen because that's part of the statistics playing out.
So less fear, better execution on both entries and exits. It sounds like you start seeing the market more objectively.
That's exactly it. It stops being this threatening thing you have to outsmart. It just becomes a stream of information presenting potential opportunities that either fit your edge or don't. You're focused entirely on executing your plan, not on the outcome of any one trade.
Now, Douglas adds one final piece, right? Something about responsibility.
Yes, and this might be the toughest part for many people. Achieving this level of mastery requires taking complete and total responsibility for every single outcome.
Complete responsibility, even if there's a flash crash or some crazy news event.
Yes. According to Douglas, you can't blame the market. You can't blame your broker's platform. You can't blame the news. Your results are purely a reflection of your mindset, your rules, and your discipline in applying them.
Oof, that's humbling. No excuses.
No excuses. Accepting that level of responsibility is what stops the blame game, prevents those emotional reactions, and forces you to constantly refine your own process, your own psychology.
Wow. Okay. So if we try to boil this down.
If we connect this to the bigger picture, what Douglas is really saying is that consistent success in trading isn't about finding some magic indicator. It's an internal game. It's about developing the mental resilience to perform optimally, to execute flawlessly in an environment that is fundamentally, inherently uncertain. Mastering the market starts with mastering yourself.
That's powerful. Okay, so key takeaways for everyone listening. First, your mindset, especially radical acceptance of uncertainty, is way more important than your specific strategy. Get the mind right first. Second, embrace that uncertainty. Don't fight it. The market owes you nothing, and accepting that frees you from so much emotional pain.
Absolutely.
And third, think like a casino. Focus on executing your edge over a long series of trades. Let the probabilities work. Don't get hung up on any single win or loss.
Nail on the head. That's the core of it.
This psychological shift, it really feels like the dividing line between the amateurs who stay stuck and the pros who achieve consistency. You've got to face that mental baggage. So here's something to really mull over. What if you started viewing every single losing trade, not as a personal failure, not as something the market did to you, but simply as the necessary statistical cost you pay to confirm your long-term edge? How much would that single shift change your day-to-day trading decisions, your stress levels, your overall emotional state? Worth thinking about. Thank you for joining us for this deep dive into trading psychology. Until next time, stay disciplined, stay focused, and work towards finding your zone.